Okay, afternoon everybody. Welcome to the webinar. For those of you who don't know me, I'm Patrick Connolly and I'm here joined today with Gareth Stead. And we're both accountants in our Windsor office. So Quantum Advisory, we're a boutique accounting firm with offices in Windsor and Wollongong. And our mission is to help family businesses to gain control, grow profits and reduce tax. So welcome to the webinar. We're going to try and give you a fairly brief rundown today on FBT and what business owners and managers need to know about FBT 2022 as we move closer to the end of the FBT year. So also we're going to have, there'll be an opportunity for questions at the end, so feel free to throw any questions in the Q&A box. There'll also be a brief survey at the end, which we would appreciate your feedback on, and we'll also give a copy of the recording to everybody who's registered and provides that feedback. So the agenda today is, first of all, we're going to run through what is FBT and why does it exist? What are the strategies and opportunities? So what, you have to click again there, Gareth. Oh, no, okay. Some slide issues here. There we go. So what are the exemptions and opportunities available? And what do we need to do to minimise our risk with the falling on the wrong side of the ATO?
So according to the ABS, FBT only provides about 9% of government revenue. So a range of people have raised concerns as to the cost of actually complying with FBT, the amount of paperwork to fill out essentially, particularly when you compare it to the amount of revenue actually raised. So I guess the question is, why does FBT exist? Why can't they just get rid of it?
So why does FBT exist? Well, what is the point of it? So in some senses, FBT is almost a preventative tax. The idea of FBT is to make sure that any benefits that an employer gives to an employee are taxed and that no one gains an advantage by providing benefits instead of by providing cash. So if we didn't have FBT, why would you put anything through payroll and get taxed? Why wouldn't you just pay everything on behalf of your employee, give them a car, pay their rent, and pay for their groceries? Of course, that'd be far more tax effective. So no, the government doesn't collect much FBT, but it's the existence of FBT that stops a lot of that behaviour. So what are the common fringe benefits that we see? So obviously the big one is motor vehicles. That's the obvious one that lots of employers provide employees with motor vehicles that are either used primarily or at least some of the time for personal use, and that gives rise to a fringe benefit. Expense benefits. So anytime an employer pays an expense on behalf of an employee, private expense, so we see some of those sometimes of private health insurance, school fees, sometimes there is rent, but it could be anything, any expense that is incurred by the employee in a private nature, but paid for by the employer, gives rise to an expense benefit. Loans and debt waivers. So anytime an employer loans money to an employee, it doesn't charge a market rate of interest or charges less than a market rate of interest, that gives rise to a benefit because the employer is giving a benefit to the employee in connection with their employment. And the ATO sets a benchmark interest rate to help determine that. Similarly, debt waivers. So if the employer loans money to an employee, either at that rate or below that rate, if they then go and write off that debt or some of that debt, obviously, essentially, the employer is just giving them cash and they've forgotten about it, so that needs to be taxed. Employee entertainment, so wining and dining your employees generally gives rise to a benefit, although there are some exemptions. And residual benefits are anything else that doesn't neatly fit into one of the other categories of benefits, but has the nature of a benefit provided by an employer to an employee, will get caught there. The ones we see most often are benefits that are motor vehicles that aren't cars. So that things like motorcycles, people movers, they're not actually treated as cars for FBT purposes, but they are still provision of a benefit, so they come under that residual benefit heading.
So there are a few FBT exemptions that are available. The main ones that we'll be addressing in more detail in the further slides are motor vehicle exemptions. So for example, commercial vehicles, where there's only incidental personal use, things like panel vans and utes. Also minor benefit exemptions. So small benefits that are that are minor and infrequent. Also, we'll be covering the otherwise deductible rule. So essentially, any expenses that an employee would ordinarily be able to deduct themselves won't be caught by FBT. Also, meal exemptions. So when meals provided to employees are not caught by FBT. And finally, we'll be looking at COVID-related exemptions. So costs paid for by an employer that are not caught by FBT. So with regards to motor vehicle exemptions, so typically all vehicles have FBT apply except for vehicles that are commercial in nature. So for example, panel vans, utes, or other commercial vehicles like trucks. And in those cases, there is a small amount of private use allowed, but it has to be minor and infrequent, essentially. So travel between home and work is fine. Travel that's incidental to the course of duties of employment. So, for example, dropping to the post office on the way home from work, that would be fine. But broadly speaking, it does have to be minor and infrequent, and the ATO has a guide of 1,000 kilometres a year.
Like anything with this fringe benefit stuff, it's all about guidelines. There's no hard fast rules, so that is a guide that's useful. But if you've done more kilometres but you've got a good backup, we can sometimes work with that too.
Yeah, so we've got a few examples here on the screen. So on the top left, we've got a panel van. So typically they qualify for work-related use exemption. The one on the right there, the ute. So single cab utes also generally apply for the exemption. Again, the minor and infrequent use rules apply for all of these vehicles. The vehicle on the left there, four-wheel drive. So typically these are considered as private vehicles. However, they do qualify for the work-related use exemption if they're designed to carry a load of 1 tonne or more. If they're designed to carry more than 8 passengers, or they're not designed for the principal purpose of carrying passengers. So in other words, essentially, if you've got a wagon style four-wheel drive, they will most likely be considered private vehicles.
There's not going to be many four-wheel drives. I guess we're trying to say they're going to fall into this category. Often people do come to us and suggest that should be the case, but we've got to be able to demonstrate that it's got a carrying capacity of a load of 1 tonne. It's got more than 8 seats. And even then, the ATO will consider things like, the appearance of the vehicle, the way it's promoted in its literature, the other specs. So it's very rare occurrence that we're going to be able to get a commercial vehicle exemption for a four-wheel drive.
That's it. And the other one that's not so clear too is dual cab utes. So typically they qualify for the work-related use, but they have to be not for the principal purpose of carrying passengers. And they also have to have a load capacity of more than 680 kilos. There are some complex rules around number of passengers and weight of passengers, etc. However, generally speaking, they have to be able to, their primary purpose has to be carrying a load.
All right, so if you go through you're looking at motor vehicles and you've gone through that exercise and you've got some dual cab utes or four-wheel drives that aren't eligible, and then of course you've got your other private motor vehicles which are just not eligible for the exemption, then comes down to, well, how do we account for the benefit that's been provided to the employee? So obviously that's not a very clear-cut calculation. If you've given someone a car to use for the year, how do you work out what dollar value benefit the employer provided to the employee? There's 2 methods to work that out. The first method is the simplest method, and it's called the statutory formula. Essentially, for this method, you just take the cost of the vehicle and you multiply that by 20%, and you say that's the value that's been provided. So it's just an arbitrary calculation, and essentially it's saying, that's as a rough guide at what value the employee's got from that car is just to take 20%. The advantage of that is you do not need a logbook. You don't need any detailed calculations, and if you've got little or no business use, then essentially you're getting a tax deduction for some of what is essentially a private vehicle. And that's why cars are considered concessionally taxed for FBT. They're not tax-free, but they are concessionally taxed, and that generally you're not going to be paying tax on the full amount of the benefit. The alternative to that is the second method, the operating cost method. So this is far more detailed and complicated, but can give you a better result depending on the circumstances. So for the operating cost method, you're trying to work out what the real value has been to the employee. So you take the actual running cost for the year, so go back through the books, look at what you spent on petrol, repairs and maintenance, rego, everything else, add that up. You then look at depreciation and interest. So depreciation on the vehicle, also interest, whether you paid interest or not, it's a deemed calculation. So what would interest on that vehicle cost you, whether you paid it or not. You add that to your actual running costs. And then you say, all right, so between depreciation, interest, running costs, that's cost us 25 grand this year. If a logbook shows that 50% of that was business use and 50% was private use, then therefore the value is $25,000 times 50%. We've provided that employee with $12,500 worth of benefit. So to use that method, you need to have a logbook. And there's lots of different ways you can do that now. You can get the book, or there's all sorts of apps available that can help you track that. The advantage of this method is that if you've got a high business use, if there's really only a small amount of private use, then you can likely get a much smaller benefit amount that you need to deal with. If you use this method, the logbook does need to be kept, but it only needs to be kept for 3 months. Every trip recorded for 3 months, and then as long as the pattern of use doesn't change, that's good for 5 years. So generally, as a rule of thumb, we would say if you estimate that your business use might be at least 40%, then it's going to be worth keeping a logbook to check whether you get a better result out of using the operating cost method. The way we do things here at Quantum is we send out a questionnaire to our clients that asks for all the information that enables us to calculate using both methods, and then we choose the method that gives us the best tax result. Another exemption is the minor benefits exemption. So if you provide benefits to your employees that are minor and infrequent, we can disregard them for FBT purposes. This sounds quite simple, but it can get quite complicated. The first characteristic there is minor. That's very easy to determine because the ATO gives us a dollar figure. So if it's the value of the benefit is less than $300, it is a minor benefit. So that's easy to tick or cross. Worth noting that it needs to be less than $300. It's actually been cases where the ATO has gotten people who have spent, given someone a $300 gift voucher, and they've said, well, that's not less than $300. So $299.99 and no more. But that's fairly clear cut. The next part is it infrequent? And there's no hard and fast rule here. There's a lot of shades of grey about what's infrequent and what's not, but it needs to be both minor and infrequent. Give you an example, there's a famous case, or probably famous is the wrong word, I guess. If you're an accountant, it's famous. Yeah, infamous for accountants, and nobody else cares. There's a case that the ATO took action on where they thought that a benefit had been provided, and that was challenged by the taxpayer. The taxpayer had provided an employee in the course of one FBT year 48 taxi trips home. So this employee was often working in different locations or had different functions, and the employer often paid for their taxi home from work. Now, travel from work to home is not deductible. Therefore, if you are regularly paying for your employee to go from work to home, that was where the ATO was coming from. That should be a benefit. However, it was actually found that even though there was 48 trips in a year, it was still qualifying for the minor and infrequent exemption because the 48 trips were not planned. They were last minute ideas. They weren't regular. So that wasn't happening every Monday afternoon at 5 o'clock. It was just happening on an ad hoc basis. The ATO found, it was found against the ATO in that case, that even then it qualified for minor and infrequent. And the reason I mentioned that is to say that just to demonstrate there really is no hard and fast rule. We think if you go and give your employee a $299 gift voucher every Friday afternoon, that's not going to qualify. There's a regularity to that that means it's not infrequent. But as long as the benefits you're providing are truly on an ad hoc basis and not a regular and planned in advance occurrence, then I think generally you should be okay. But this one we've got to take on a case-by-case basis. The next exemption is the work-related exemptions, or what's called the otherwise deductible rule. And this exemption is much simpler. So this says anything that anything the employer pays for on behalf of the employee that the employee otherwise could have claimed a tax deduction for if they'd paid for themselves shouldn't be subject to FBT. The basic premise here is that if the employer paid wages of $500 to an employee and they used that to go and buy a drill, and they needed that for work, the employer would claim a tax deduction and therefore that amount would not be taxed. So if the employer just buys it for the employee, the effect is exactly the same and therefore there shouldn't be any FBT. So anything you're buying for employees that they do need for work and would be able to claim a tax deduction for if they bought themselves is exempt. So there's some examples there: portable electronics, software, protective clothing, briefcase, any tools of trade. All of those things can be provided without any FBT worries.
So the next one is meal entertainment expenses. So broadly speaking, when you're providing food and drink to employees, it's considered to be a fringe benefit. Having said that, if you were to provide food and drink to an employee on a working day and it was within the business premises, that would typically be FBT exempt. So, you know, giving the employee, or taking the employee to the pub or to a restaurant, things like that, functions, they would typically be considered as FBT entertainment benefits. Now, it doesn't really happen very frequently, but that rule doesn't apply, as in you don't get the exemption if it's been provided under salary packaging arrangement.
We put that line on there to cover ourselves, but I've yet in my years to see anybody who's salary sacrificing their lunch at work, but maybe there's some employers like that require that, so you can't do it.
Okay, so the next ones are the COVID exemptions. So essentially, costs that the employer has paid for relating to or during this COVID period. Some of these are actually exempt from FBT. So, for example, providing COVID tests to employees, where you're providing emergency food or transport accommodation, and also if you're assisting an employee to get to a COVID vaccination location, even things like PPE, you know, gloves, masks, hand sanitizer, other safety items.
Yeah, I think the government was just carrying themselves off here and they made it clear earlier this year that these things would be exempt from FBT. I don't know anybody that was getting ready to pay FBT on these things. I think it was fairly clear they were either minor or just part of work, and they would have been fairly unpopular if they didn't do that. The other item we've got there at the bottom is that cars can be garaged at home. So ordinarily, when working out the benefit, a fringe benefit of a motor vehicle, you look at how many days the car was available to the employee to be used. And if the car is garaged at the employee's home, it's deemed to be available for use ordinarily. They've just made a little clarification here that if the car was garaged at home, but the employee was in lockdown or in isolation, that this doesn't apply if they didn't drive the car. I think it's just a common sense thing, and there's some more detail around that. So I just want to go through now some key worked examples. One of the questions we get a lot, quite common, is a business owner or a business owner's family member coming to us and saying, I'm going to buy a new car. There's really not very much or any business use. Should I just buy that car myself, or is there still a benefit in buying that car through the business? So we've done a bit of a comparison here. See that the value we're saying we're going to buy a $50,000 motor vehicle. It's going to cost us $10,000 per annum in running costs. We've assumed for this example that it's 20% business use, 80% private use. The individual's on the middle tax rate of 39%, and the company is a small business at 25% tax rate. So in the first column on the left-hand side, we've looked at, well, how much is it going to cost the employee to own the vehicle themselves? They're going to have $10,000 per year running costs. They're going to have annual finance repayments of $11,340, but they are going to claim a tax deduction for the 20% private use. So they're going to look at the depreciation of the car and the running costs, multiply that by 20%, gives them a tax deduction of $4,500, which gives them a saving of $1,755. So the total cash cost to the employee, if they own the vehicle themselves, you can see is $19,585. Now, for the employee to get $19,585 from the business, they obviously need to pay tax at their personal rate of 39%. So the total cash that would need to exit the business for the employee to be able to get $19,585 would be $32,106. So we've got that as the total cash cost to the business after tax is $32,000. If the employer owns the vehicle, they will have running costs of $10,000 less GST. So that's the first advantage. So the running costs are $9,091. Got the same financial payments. They're going to deal with the FBT using the statutory method. So they take the $50,000, they multiply that by 20%, and that contribution goes into the company's books and out of the company's books. But the tax, the employee is going to pay tax on that contribution. We've assumed it's been paid as a salary, as a bonus or a trust distribution. And the tax for the employee is $7,991. So we've included that on the list of things the employer needs to pay. But there is a tax deduction for the full amount being claimed in the company or whatever the business structure is. So the total cash cost to the business is $23,000. So we can see that even when there's only 20% business use, it's about $9,000 saving to buy the car in the business rather than to buy it personally. And that's because, and this will be true in almost all cases, that it's generally, not always, but almost always better to buy in the business because cars are concessionally taxed for FBT. So there is a tax advantage generally to owning the business. Another example, this is around staff lunches. So that's just the meal entertainment exemption you were telling us about, Gareth. So this is looking at if we want to, what saving is there to the employer to pay for lunch. So if the employer decides they want to cover staff lunches from now on, they've got two options. First option is, and sorry, I should say first, the cost of lunch we're determining is $8 a day, and there's 45 weeks in a year. So if the employer decides, I want to pay for your lunch as a benefit just to keep you happy and motivated and increase my chances of retaining you, they've got the option of, one, they can pay the employee $2,748 so that after tax, the employee has enough to pay for their lunch. On top of that, though, the employer's got to be aware of their own costs of $467, but they do get a full deduction for everything they paid to the employee. So the employer's after-tax cost of doing it that way is $1,961. Whereas if the employer just buys the lunch, it's FBT exempt, so there's no tax consideration, income tax. They get to claim the GST back, and they get a tax deduction themselves for what they spent. The after-tax cost is only $998. So the cash saving per employee is $963 for the year. I guess what we're saying with all of that is because it's FBT exempt, there's obviously an advantage, whereas the employee would have to pay tax on their income to be able to buy that, the employer can buy that tax-free.
So the next thing we're going to look at is minimising risk around FBT and the actual and audits essentially. So the ATO's latest statistics reveal that the net FBT gap currently sits at around $1.04 billion, or 21.2%, which basically means that employers are only paying about just under 80% of the theoretical FBT that they should be paying.
I mean, they would say that, but I guess the point is there that they feel like there's a big gap that they could be getting an extra $1 billion if they did some more compliance activity. So we should expect that there will be more compliance activity going forward.
Yeah, so primarily what the ATO will look for is businesses who haven't taken action or haven't taken sufficient action in relation to FBT. And so we'll go through some examples of things that can trigger an audit in that regard. So with motor vehicles, for example, the ATO has a lot of data matching capabilities these days, and they obtain detail from state governments and other departments relating to motor vehicles. So it's very easy for them to track ownership. And one of the things they look for is when motor vehicle expenses are being claimed in the tax return, the ATO would generally expect that there would be an FBT return lodged with some sort of declaration relating to motor vehicles. So it's critical that businesses can prove that they have addressed FBT in terms of motor vehicles. So even though most of our clients would have a nil FBT return, because we're clearing that FBT liability out with an employee contribution, we still lodge a nil return. So we're demonstrating to the ATO that we have actually addressed the FBT issue. Additionally, lodging a tax return, a nil return with the ATO, limits the ATO's ability to go back in time to audit. It's also critical for employers to have all the relevant documentation in place. So it's the employer's responsibility to make sure that all these things are addressed. For example, the letters with regards to commercial vehicles. And employers need to make sure they're signed and filed. So if you're ever audited, you don't end up with a big FBT bill.
I think one thing that needs to be just really probably repeated again there is that if you've lodged an FBT return, even with a nil payable, then the ATO only has the right to go back 2 years and audit your FBT return lodgements. If you haven't lodged an FBT tax return, the ATO can go back and audit you for as long as they want because they said you haven't complied at all. Therefore, we'll go back as long as we want, and generally they go 5 or 7 years and look at whether you've dealt with FBT properly in all those years. So just by lodging the return, you're actually greatly limiting the audit scope because you've demonstrated that you've done your best to comply and you set that audit timeline in place.
So the other one is relating to things like private phone and internet expense. So particularly over this COVID period, employers might be contributing to employees' phone and internet costs. However, the ATO expects that an employee would have a diary essentially recording how much of their internet expense is actually relating to business use. The other alternative to that is an employee could receive an allowance, which has a benefit of basically giving the responsibility to the employee for the substantiation. However, if you do decide to essentially reimburse an employee for their phone and internet costs, then it is the employer's responsibility to make sure they have the documentation on hand to prove it.
Yeah, just on employee contributions, and maybe probably should have mentioned this earlier in the webinar now thinking about it, but employee contributions. So when we've worked out the value of a benefit that's been provided to an employee, the employer then has a couple of options to deal with that benefit. The first option is you just pay fringe benefits tax. So if you've given your employee a benefit that's worth $100, you declare that benefit's been provided in your FBT return. You've got an amount to pay of $47, being the FBT rate times $100. But the other, and often or usually more beneficial option, is to do what's called an employee contribution. So if I work out that I've got an employee that's got a $100 benefit, rather than just declaring that, what I can do is I can say to my employee, well, if you give me $100 back, there's no net benefit being provided. Obviously, your employee is not going to give you $100 back. But the way you can make that happen is via a journal entry. So if I've given this employee $100 benefit, I could pay that employee a bonus of $138. $38 pays the tax on the bonus. The $100 is retained by me as the employer to offset that benefit. And therefore, I paid $38 instead of $47. So that's ordinarily that's what we would use an employee contribution, because generally that gives us a better result. The way we work here at Quantum is that when we've gone through your FBT return, normally we're lodging a nil return, but with that we give you a summary of all the contributions that we've agreed to, and that'll tell you that you've got to pay bonuses. Bonuses need to be put through payroll for these employees. Trust distributions need to be made for these employees, and this is just clarifying that all of that can be calculated after the end of the FBT year by 31 March. It needs to be documented correctly by the due date of the return, being 21 May, and it needs to be processed, so that payments need to actually be put through payroll or made if you're making them by 30 June of the same income tax year. So that's just clarifying the timing around those things. We'll of course communicate that too when we send you out your FBT summaries. And this one I'll just touch on very quickly because it's probably not too relevant to too many people. But where you're using a novated lease, the ATO is, so novated lease is where an employee procures a vehicle, leases a vehicle, and while the employee is employed by the employer agrees to be responsible for those payments, which allows the employee to salary sacrifice those payments so that they get access to that concessional tax treatment for cars. That's all fine. What the ATO is saying now, though, is a novated lease is set up so that you're providing the vehicle. The costs are for providing the vehicle for that year. If the lease is set up in a way in which case that enables the employee to be paying off more of the vehicle or purchasing the vehicle faster than its useful life, then essentially that salary sacrifice agreement isn't a bona fide lease, and therefore the ATO will call those payments a residual benefit. All very technical, probably not really relevant. The main point in all of that is, if you're doing a novated lease, make sure you use a novated lease company. This is only going to catch people who try and do this in-house, which I wouldn't be recommending anyway. But if you're inclined to do that in-house, I really would recommend against it, or make sure you understand this. But the simplest thing is just to use an outsourced novated lease provider to make sure that all of this is taken care of and you're not worrying about any of it. So look, that brings us to the end of our webinar. We do have a couple of questions though already in the chat. You put them on a screen, I can see. Yep. Okay, so we've got one question from Rick Dunn. Do you have to use the same FBT method across all vehicles, or can there be a mix?
So the answer is to that is no. So you can actually use a mix across various vehicles, and you can also change it up each year. So some years it might make sense to use the statutory method, and the other years it might make sense to use the operating method, and obviously using a logbook for those periods. It really depends on the mix of usage and the cost of the vehicle. Yeah, so it does come back to yeah, you can use a mix. And that's what we would do. Like I said, we'll get all the information to be able to check for every car what's the best, and we'll have some that are operating under the statutory. Are meals offered to technicians at the customer site to be defined, offered at the employee's business premises, hence a meal entertainment exemption? That's a complicated one. I would think if the technicians, it's probably going to come down to, do the technicians have a regular place of work, which is a whole other determination. If they don't have a regular place of work, then I would think that that's fine, because the customer site becomes their regular place of work. If they did have a regular place of work, I'm going to take that on notice, sorry. But certainly feel free to contact us with that question. I'm happy to answer that for you in detail. This is the one at the bottom there we haven't read yet. So is the 3 months or 5 years change for the logbook change if the vehicle is updated? No, not necessarily. So if you've got a logbook for a vehicle, like I said, you need to keep it for 3 months, and it's good for 5 years as long as your pattern of use doesn't change. You don't have to keep a new logbook just because you get a new car. If your pattern of use is exactly the same, you're able to use the same logbook. Another question, there's plenty of dual cabs out there, especially on weekends, camping, etc. Do people ever get picked up for that? Look, it comes down to how honest they are with their declarations, I guess. I don't think the ATO's out there checking. But well, the other thing too is if you've got a branded vehicle, it's probably not a good idea to be forward driving with it on the weekend. Yeah. That's, you know, if an ATO officer sees that, they might go looking. Look, in terms of their audit activity, I'm not recommending this, but no, I've never seen the ATO go and check that your logbook is correct, but of course it'd be a criminal offence for it to be incorrect. So if you are using it for things that are more than incidental personal use, then you shouldn't be declaring that you're not. But ultimately, if you've made that declaration, you're taking that risk. But no, I mean, I've never personally seen that followed up on by the ATO. Doesn't mean that it can't be. We go back to the chat. There's another one there, I think. Is there any time limit for employees' advanced loans to be exempt for FBT? No. No, not theoretically. In practice, if you've loaned, if there's an employee loan that's there for a week and repaid the next payroll, practice that might not often get picked up, but no, by legislation, there's no time limit. So if you give a loan for a day, if you want to be compliant to the letter, it should be included in your FBT return. Yeah. Okay, all right, well, that looks like all the questions there, I think. So thank you, everybody. There will be a survey at the end, like we said, so we really would appreciate your feedback. And if you've got any questions about FBT or anything else, don't hesitate to reach out to one of us. Thanks. Good.